Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for March 24th, 2013. We have a market that is in bullish quiet mode. It's overbought on an annual basis using weekly RSI 14. It's 80 at the very high end of neutral on a 10-day look back using the 10-day NDX. The price relative to the 200-day moving average is at 9.35%. That's green bullish. The slope of the 50-day moving average is white bullish at 0.60. ADX has declined to 20.9, so it's no longer a trending market. It's looking more sideways, neutral. ATR percentage at 0.74% is on the border between quiet and normal. The risk index, which is the 30-period moving average of the VIX divided by the 10, is still in risk on at a 1.06 index rating, which equates to a 0.67 z-score when compared to the last 5,000 days. You can see the time series here as the market has slowed down a little bit this week. The risk on index is declining. It's still favorable, but it is going through sort of a natural pullback here. No change in the blended monthly portfolios. The 26 ETF is still Australia finance small caps, and the 13 ETF is Australia small caps and Asia less Japan, with the next reevaluation being due on or about 1 April. Theoretical exposure of the market is at 80%. The model portfolio will be at 100% exposed. And this week we're just updating stops. There were 4 symbols that received dividend payouts this week, and so the model portfolio is adjusted to reflect that. Here's an example trade of the week link at YouTube, and it's a discussion of the use of the regression line crossover in the Forex. It happens to be 2 trades that are looking at the Euro USD pair, and it offers some insights into the possibility of using the mastermind chat room to improve trading practice. The ETF portfolios, the current readings, Japan has moved to the top of the stack. We got Latin America, emerging markets, and treasuries on cash in the 13, and in the 26 it's Latin America and quite a few of the emerging markets and alternate ETFs on cash position as well. ETF2 database, the top 10 indexes. We've got 8 out of 10 are on a buy signal for the indicator using the moving average filter, and so that keeps us at a 20% cash and an 80% invested. We have the S&P. The U.S. market is now slightly better than the globals, and inside the U.S. that is the strength is mid caps, then small caps, then large caps, then tech. The 2 strongest sectors are U.S. mid caps and Japan, and then the 2 weakest remain Latin America and emerging markets. Looking at the world market model, everything in the U.S. is above average except for large cap tech, and then the mid cap value and blend are both exceptionally strong. Japan, exceptionally strong. Asia less Japan, above average. You see some real differentiation now in between winners and losers in Asia less Japan, and Europe starting to cool off here. Pardon me for coughing in your ear. In the business sectors, it's still mostly the U.S. now is leading the way or tied across the board. So continuing the trend of seeing money flow back to the U.S. Looking at the ETF top 30, Japan, Vietnam, consumer staples, transportation. This MLP index, that is a master limited partnership index ETF. It's cap weighted. So it gets it's focused in pretty hard on energy sector. Philippines, home construction, a master limited partnership for infrastructure. So those seem to be doing pretty well. Areas where strength is coming into the market are those where it's white on average, but then green on relative strength, and so that would be this MLP index note. Consumer discretionary, banks, oil and gas index, mortgages, oil and gas, Japan, S&P retail, small cap growth, small cap broad-based, S&P dividends, and then the U.S. mid-caps. That's how strong mid-caps have been, that they're able to crack the top 30. Looking at the Dow, the strength remains with Hewlett-Packard. Then Bank of America, Travelers in the financial sector. Johnson & Johnson has now moved to the top of the stack, and we've watched Johnson & Johnson climb up from deep value now all the way back up to the top 5. Boeing and American Express, bottom feeders. Notice that even though the weakest members of the Dow are not exceptionally poor, that's just a sign of strength in the U.S. Alcoa, United Health, Caterpillar, Microsoft, and Intel. We can see Coke starting to move up the list now. It's white on relative strength and yellow on average. That's strong. So all of these here that are white on relative strength and yellow, that's sign of value being recognized. Walmart, DuPont, Coke, and IBM. So keep an eye on those. And then the ETF liquidity for your reference. I'm going to shift now to the daily report. Buy signals on emerging markets in Latin America in the overreaction and channeling systems, respectively. Quite a few patterns on channeling overreaction in the ETFs. And there's a 5-day down in Brazil. 551W in Asia less Japan and finance. That would be a very great interest given how strong the financial sector has been. And then also 551Ws on GE and Walmart. Auto framer triggering for Cisco, Asia less Japan, JP Morgan, Cliffs Natural Resources, General Electric, the coal ETF, Latin America and Brazil, and emerging markets. So some deep value plays there being available. You see Caterpillar tests out at over 5-1 on the auto framer. Cisco ought to be very interesting to you with an 8 on RSI2, number 2 on max pain range compression, a 2-to-1 reward to risk mechanically, and then both a channeling and an overreaction. Doesn't get much better than that in Cisco. Just to notice the strength here in Hewlett-Packard. It was a big winner on Friday, and it's been an exceptional performer over each of these measured look-back periods over the last 1 day, 10 days, 1 month, 3 months, 6 months. It's been the exceptional performer now in the Dow. Among the ETFs, again, plenty of dojis to choose from, some channeling and overreactions. Brazil ought to be very interesting for you. It's number 1 on max pain range compression. It's a 5-day down. It's a channeling and overreaction. Number 1 max pain range compression, I say again. 6-to-1 on the auto framer, 3.0 on the frog quality, and then a 0 on RSI2. So that's that all signs pointing towards Brazil to be a potential big mover. Emerging markets coming in at 7.1 and channeling and overreaction. Latin America 5-1 and number 3 on max pain range compression. So there's a lot to commend those top 5 to us. You see the 30-day regression line starting to flatten out here a little bit. That's where some of the weakness in that risk index is occurring. It's been sideways for the last 5 days. The slope of that regression line is still above its 10-period moving average, which is fine. Finding a natural resting place right here as we look at the percent stretch indicator, still more than 1 standard deviation above average. Still room to go, though, because it is just barely above its 6-month average in terms of steepness. for the regression line. So this looks like right now to be a natural pause with support developing at 154, and the bulls are still in charge. You can see the relative strength in Japan here and in the Dow, and XLP continues to be a winner. The 10-period regression line Z-scores come back to baseline as the market is kind of leveling off and finding support here at the upper half of the river, at the upper shore of the river, excuse me. The 90-period is rolling over, though, and that suggests a potential, if this is the first move up here from 130 to 145, and then this was the pullback, this is the kind of pullback the market gave the last time that it peaked above 1.0 on the Z-score, and then rolled over this far, and so it came back about 8%. So an 8% pullback here would bring it back to about 145-ish. Which would be the bottom side of the river, and that would leave the bull still intact, but that's the kind of magnitude of the change. The 30 is still pointing up, but starting to stall a little bit near the top of its normal channel, and so this is, in my view, a place to make sure that you've got your stops respected, you've identified the winners. So if we get a resumption here after this little sideways move, I mean, the healthy thing here is that it hasn't even hardly failed back into the river. The last two times we've seen a pullback to the bottom of the river, and it continued to go fine. This time it's only been a sideways kind of a channel, so that could bode well for another leg up, but we're still going to respect the potential for an 8% move down. Just more reference charts. I'll just flash these one at a time, and you can stop and review as you see the need. And thanks for your kind attention, and we'll see you in the chat room.